Good evening. We begin tonight with a major shift in global financial markets, where precious metals have experienced a sharp downturn following weeks of exceptional gains. Gold and silver, two commodities that reached unprecedented price levels just days ago, have seen their values decline substantially in what analysts are describing as one of the most dramatic reversals in decades. This movement in the metals market comes as investors reassess their positions amid changing expectations about United States monetary policy and evolving geopolitical conditions. The recent turbulence in precious metal prices represents a significant departure from the rally that dominated trading throughout January. During that period, both gold and silver climbed to heights never before witnessed in their trading history. Investors had been directing substantial capital into these traditional safe haven assets, responding to uncertainty in the international political landscape. However, the announcement of a key appointment within the United States Federal Reserve System has altered market sentiment considerably, triggering a sell-off that has brought prices down from their record peaks. On Friday, spot gold experienced its most severe single-day decline since 1983, with values falling by more than 9%. Silver witnessed an even more dramatic drop, plunging 27% before showing modest recovery as trading resumed on Monday. These declines have erased significant portions of the gains accumulated during the previous rally, leaving many investors who had sought protection in precious metals facing unexpected losses. While precious metals retreated, currency markets showed contrasting movement. The United States dollar strengthened slightly, ticking upward as confidence returned to traditional currency holdings. Meanwhile, in London, the Financial Times Stock Exchange 100 Index, commonly known as the FTSE 100, demonstrated resilience despite opening lower. The British benchmark index overcame its weak beginning and climbed throughout the trading session, ultimately closing with gains of 1.2%. The index reached 10,341.56 points at the close, marking a record closing level. During intraday trading, the FTSE 100 touched an even higher point of 10,345.48, establishing a new peak for the index. By 1700 hours Greenwich Mean Time on Monday, gold was trading down 4.6% at $4,659.16 per ounce. Silver had declined 7.63% to reach $78.70. These prices represent substantial retreats from the all-time highs both metals had achieved in the preceding week. Gold had surpassed $5,500 per ounce, while silver had climbed above $120. The current levels place both commodities well below those extraordinary peaks. Market analysts have identified multiple factors contributing to the sharp reversal in precious metal prices. Beyond the impact of the Federal Reserve appointment, changes in trading requirements on a major exchange have played a role in accelerating the decline. These modifications increase the cost for speculative traders to maintain positions in precious metals, adding additional downward pressure on prices, as some market participants were forced to liquidate holdings or chose to exit positions due to the increased expense of maintaining them. Investment professionals are noting that the volatility in precious metals has delivered an unexpected lesson to many market participants. Russ Mould, who serves as investment director at A.J. Bell, offered commentary on the situation. He observed that numerous investors had purchased gold and silver with the intention of protecting their portfolios against an unstable geopolitical environment. However, these investors have now discovered through difficult experience that these assets, despite their reputation as safe havens, can themselves exhibit significant volatility. The sharp price swings have demonstrated that no asset class is immune to sudden market movements, even those traditionally viewed as stable stores of value. The financial markets had been experiencing heightened concern regarding the independence of the United States Federal Reserve in recent weeks. These worries were alleviated to a considerable degree when the nomination of Kevin Warsh to lead the central bank was announced on Friday. Warsh previously served as a governor of the Federal Reserve, bringing established credentials and experience within the institution. The financial markets generally welcomed his nomination, viewing the selection as a reassuring signal about the future direction of monetary policy. The announcement triggered an immediate response in currency markets, with the United States dollar rising by 1% in value. The selection of Warsh also served to ease concerns that had been mounting about the Federal Reserve maintaining its traditional independence from political influence. These concerns had intensified following a series of public criticisms directed at Jerome Powell, the incumbent Federal Reserve chair. Powell had faced attacks over his approach to interest rate policy, particularly his measured stance on rate reductions. The president had expressed a desire for faster rate cuts than Powell had been willing to implement, leading to tensions that raised questions about potential political pressure on the central bank. The nomination of Warsh, with his background as a former Federal Reserve governor, has been interpreted by many market observers as an indication that the institution's independence will be preserved. Despite the dramatic declines witnessed over recent trading sessions, it is important to place the current price levels in proper context. The price of gold, even after its substantial fall, has only retreated to approximately where it stood 2 weeks earlier. Furthermore, gold remains valued about 70% higher than it was at the corresponding point in the previous year. This longer-term perspective indicates that while recent buyers at peak prices have experienced losses, those who invested in gold earlier continue to hold significant gains. The metal's performance over the past year has still been exceptionally strong by historical standards. The sell-off in commodities extended beyond precious metals on Monday. Various commodity markets experienced declining prices as investors reassessed their positions across multiple asset classes. This broad-based movement suggests a general shift in market sentiment, rather than concerns specific to gold and silver alone. The synchronized decline across commodity categories indicates that investors are repositioning their portfolios in response to changing economic expectations and monetary policy outlooks. Asian stock markets reflected the uncertain mood among investors, with major indices across the region posting losses. South Korea's benchmark Kospi index led the declines, falling by 5% during Monday's trading session. The magnitude of this drop indicates significant concern among investors in that market. Elsewhere in the Asian region, Hong Kong's Hang Seng index dropped by 2%, showing that the negative sentiment was not confined to a single market. Japan's Nikkei 225 index was also lower, declining by more than 1%. These movements across multiple Asian markets demonstrate the widespread nature of investor caution. European markets presented a mixed picture as trading progressed throughout Monday. The United Kingdom's FTSE 100 index initially followed the downward trend seen in Asian markets, opening lower at the start of the trading day. However, as the session continued, the index reversed course and began climbing. By the close of trading, the FTSE 100 had risen 1.2%, achieving not only a positive day but also reaching record levels. This recovery demonstrates the varying reactions across different markets to the same underlying global conditions. Within the FTSE 100, the fall in commodity prices created particular pressure for mining companies. These firms, whose business operations are directly tied to metal prices, saw their share values decline as the prices of the materials they extract fell. Gold mining companies were especially affected by the sharp drop in gold prices. Fresnillo, a prominent gold mining company, experienced a decline of more than 2% in its share price. Endeavour Mining, another significant gold producer, similarly saw its shares fall by more than 2%. These declines reflect investor expectations that the lower gold prices will impact the profitability and financial performance of these mining operations. United States stock markets exhibited initial weakness before recovering to post modest gains by the end of Monday's trading. The S&P 500 index, a broad measure of large American companies, initially dipped as markets opened. However, as the trading day progressed, the index recovered and moved into positive territory. By the closing bell, the S&P 500 had gained 0.5%. This recovery suggests that American investors, after an initial cautious response, found reasons for optimism in the day's developments. Global energy markets also experienced significant movement on Monday, with crude oil prices falling nearly 5%. Analysts attribute this decline to multiple concurrent factors affecting the oil market. Major oil-producing nations recently reached an agreement to maintain their current output levels rather than adjusting production. This decision to keep supply unchanged has implications for price dynamics in the oil market. Additionally, there are indications that tensions between the United States and Iran have been de-escalating. Since geopolitical tensions in regions important to oil production and transportation can drive prices higher, any easing of such tensions tends to reduce upward pressure on oil values. The strengthening of the United States dollar may have also contributed to the decline in oil prices. Oil is priced in dollars in international markets, which means that when the dollar increases in value, oil becomes more expensive for purchasers using other currencies. This can reduce demand from buyers outside the United States, placing downward pressure on prices. The interaction between currency movements and commodity prices illustrates the interconnected nature of global financial markets. The recent declines in precious metal prices come after what was an exceptional year for these commodities in 2025. Gold experienced its largest annual gain since 1979, delivering extraordinary returns to investors who held the metal throughout that year. This blockbuster performance attracted considerable attention and brought many new investors into the precious metals market. Silver also performed strongly during the same period, contributing to the overall enthusiasm for precious metals as an investment category. One of the fundamental characteristics that makes gold attractive to investors is its relative scarcity. Unlike currencies that can be printed or digital assets that can be created, physical gold exists in limited quantities. According to information from the World Gold Council, a trade association representing the gold industry, approximately 216,265 tons of gold have been mined throughout all of human history. This finite supply, combined with ongoing demand from various sources, including jewelry, industrial applications, and investment purposes, underpins gold's enduring value. The scarcity factor provides gold with an intrinsic characteristic that differentiates it from many other assets and contributes to its historical role as a store of value across different cultures and time periods.